morning. I want to welcome you to the recap for the liquidity source. This morning we're going to be speaking about what our first subject is about return on investment, or ROI. It's an important metric because when you're in the real estate space, you really want to find out what goes on with your investment dollars and to find out what the return on that investment is going to be. This is a very important metric. We're going to talk about that, and I'm going to show you an example in real time. So, as I was saying, the ROI is really a measurement or a metric to show what kind of returns you get on an investment. So let me give you examples I'm going to show you. So I just recently worked with one of my clients on one of his deals. And obviously when you go to the bank, you have to put down on a spreadsheet all the money it costs for acquisition of land and how much it costs to get the permits done and the IDA approvals and all that. And then how much is it going to cost for the soft costs and how much does it cost for the hard costs. Basically, what's the total cost of the project? In this one, it's going to be a little over $12 million, which you'll see. And then, once stabilized, what the return is going to be. So you look at the first year and you can see the amount of money that was invested in the total project, that's your total investment cost, and what was the return that's initially expected on that investment. Important. So I happen to be working on a great project right now. Of course, this is a projection, but it's on a property in Port Washington. It's a development, basically multifamily. And what you're going to be able to see here is the total acquisition and development costs were almost $10.7 million. So when we first did this project, of course, we needed a much larger loan. We needed almost $7 million for the debt portion from the bank and $4.2 million in equity. But if you roll down here, when we finally went for the permanent loan, we were able to keep, after getting the permanent loan of $9,891,000, we only had $808,000 of our actual equity in the property. And the first year, we were getting $226,354 in actual income. It's amazing because now your return on cash, which was initially 8.1% when you're doing the acquisition, now becomes 28%. You're taking the amount of cash compared to the equity of $808,000. So cash on cash, it's an amazing return. And this is in real time, so it's a great example of what what one has the ability to do when they're a developer if they do it right. So the next topic I want to talk about is cash on cash. This is important and really important for the investor and the developer as well. Because what you're going to find out now is once we refinance the property, there's going to be a certain amount of equity or cash in the deal. And what is that return going to be based on how much the property is throwing off, which is going to be cash on cash. I'm going to show you an example and you'll understand it perfectly. So I'm working on a great project right now actually for one of my clients in Port Washington. And when we looked at the project, after we did the permanent financing on the project, you can see how little or the amount of equity that's left in the deal, and now how much is being thrown off and generated by the project. It's great to know because if you have, your equity drops significantly and you have a tremendous amount of cash coming in, you have a huge percentage rolling down, and you want to see what that cash on cash is really all about. I'll be able to show that to you. So now I'm going to give you an explanation on return of investment, or ROI. As you can see, the return on investment is a measurement of how much money or profits made on investment as a percentage of cost. Since this metric shows how well your investment dollars are being used, it pays to know both what the ROI and how to calculate their ROI in real estate. So here's a sample. When we did this property, we needed $12,943,850 to do the total cost. The first year, before we permed out the loan, it generated $1,011,552. That's a 7.8% return based on the $12,009,000. $1,011,552 based on the $12,943,850 is a 7.8% return. So our last topic today is on what they call net present value. It's interesting because what happens is, as you know, cash that you get in year 2, in year 3, in year 4, in year 5, is if you take it down to really what is valuable right now, it changes. So imagine we look at a number of investments, and let's say in those investments, you may get the same amount of cash over 5 years, but imagine, for example, that you're going to get $1 million over 5 years, but in one sample of a deal, you got $200,000 the first year, and then $300,000 the second year, and then $400,000 the third year, and only $100,000 the fourth year, and $0 in the fifth year. And when you work that against the same $1 million take, but in a different order, how would you know which one would be more valuable or more important? So if you're not sure, you can take a net present value of the income in all the years that you have, and there's a formula for that, so you could actually look at these budgets and income and figure out what deal is more profitable for you based on net present value. So today we're also going to talk about a topic called the net present value. And as you see, the net present value discounts all future cash flows from a project and subtracts its required investment. The analysis is used in capital budgeting to determine if a project should be undertaken when compared to alternative uses of capital or other projects. So imagine you had 5 or 10 different projects that you were looking at, and the cash flows varied all throughout the 10 years. Some years were higher than others, some years were shorter than others, and the bottom line is you really weren't sure. So what you did, you used a formula called net present value, which looks like this. You're getting the net present value based on the cash flow, 1 plus the interest rate and the term, how many years, minus the initial investment. So what would it tell you? Once it backed into the net present value, you would see different numbers, higher and lower, and then you'd be able to decide which one was best based on the budget, what was your best return based on what the net present value was of those numbers. It's an important concept to use when you're investing in many potential projects and you want to know the one that's most profitable.